Yes.
Yay, that's great. Awesome. So good morning, everybody. I know so many of you, but I want to make sure that I introduce myself so you know who I am and whether or not I have the expertise to be talking today about Mortgage 101. And I want to thank you for attending. My name is Kelly McGinnis. I'm the area manager for Prime Lending. I manage all of our Connecticut offices as well as our Vermont offices for Prime Lending, and have been in the mortgage industry for way too many years. I can't even, when I tell people now that it's 38 years, I'm just shocked even in and of myself, because I think I actually feel like I'm 38 years old. So got a lot of time in the industry, been training and coaching and mentoring mortgage loan officers and real estate professionals for most of my career. Training people is the thing that I love to do best. I think education and having correct information is so important, and never more so than today. And I pride myself on really kind of culling through a lot of data and statistics and information so that I can present to you guys, the most up-to-date information that is going on in mortgage lending. So this course, Mortgage 101, is a course that I've been is a workshop I've been doing at the board for, oh my gosh, I think 5 years. And I just think it's so important for realtors, new and experienced, to have a working knowledge of mortgage lending. Again, today, more so than ever. Yolanda and I were just talking before the presentation started about how much misinformation is out there. And when we know and have, we know that especially our millennial buyers rely on doing research and looking things up and getting information, their opportunities to get the wrong information is very, very high. So I love that you're interested in mortgage lending and you want to know what's going on. I'm going at the end of this presentation, I'm going to talk to you about general mortgage lending guidelines, how we look at things, why we look at the things you do, so that if you're working with a client and the mortgage lender tells you something that seems outrageous, maybe you'll have some context to understand why customers may be struggling to get approved or having some challenges with their financing. But at the end of this presentation, I've done a lot of seminars through the association on interest rate trends and market trends. It's one of, like, forecasting is one of the things that I work really hard at. So at the end of this presentation, we're going to talk about where mortgage rates are now, where they're going, and why. Because again, today more than ever, we need to be the voice of calm and be able to provide our buyers and your sellers with the best information possible. So we're going to jump right into it. So in order to understand mortgage lending today, okay, we have to kind of go back a little bit. And I always want to take you back to what we call the mortgage meltdown. Now, if you were in real estate in 2000, you experienced a phenomenal market from 2000 to 2008. Very different from the phenomenal market we experienced over the last couple of years, especially here in Connecticut, but a really thriving real estate economy from 2000 here in Connecticut, from 2000 to about 2008. And why was that? Why was the real estate market so hot back then? Well, the single greatest reason, there were two reasons. One, the federal government decided that they set a home ownership goal, that they wanted a certain percentage of Americans to be able to own homes. And based on that goal, they loosened up laws that basically required financial institutions to carry large capital reserves, so that in the event of loan losses, it wouldn't disable or, take a bank down, because they would have enough reserves. And what that change of law did was create an opportunity for the investment banks to get involved in mortgage lending. So this is when we saw Bear Stearns and Morgan Stanley get very involved in mortgage lending. And of course, what happened, which some of you may or may not know, is that during that time, the investment bankers, in collaboration with some of the large lending institutions, developed the loans that are known as subprime loans. And the problem with subprime loans is that they had really relaxed and unreasonable lending standards, okay? And what was driven predominantly with subprime loans, I can't even say it was credit scoring at the time, was this basic bet on the housing market that prices would continue to go up. So subprime loans, we could do, and by the way, I always say this, I was a laughing stock in my industry from 2000 to 2007 because I wouldn't do subprime loans. You know, I was trained as an underwriter. I know what it takes for a family to be able to afford a mortgage. And of course, mortgage companies were making billions and billions of dollars on subprime loans. But I always said, you know, a clear conscience is a soft pillow at night. I never wanted to put a family in a position where they couldn't afford a home. And so this was a common conversation, right? You'd be looking at somebody who had mediocre credit. Their debt to income qualifying ratios were very high. They were currently, let's say they were currently paying $1,000 a month in rent, had not been able to save any money for down payment, but now felt that they could qualify for a $2,000 mortgage payment. This happened a lot. And in the mortgage meltdown, two really distinct groups emerged. And I don't know what the percentages of each, but I'm going to tell you they were both contributory. One is you had homeowners who felt entitled to that lending. I mean, I had people say to me, well, if you're not going to give me the loan, I'm going to go down the street. No matter how much financial counseling I tried to do with these families, they were committed to getting into those situations. And of course, ultimately wound up losing their homes. The second thing is you had banks and lenders and mortgage brokers doing predatory lending where they were really, you know, maybe a subprime lender would have someone in front of them questioning whether they could afford this payment. And the predatory lender would convince them that they could do it, put them in a loan that they couldn't handle. And of course, those loans went into foreclosure. So the subprime mortgage crisis was really was the impetus for the Great Recession. The other thing that, and I'm giving you a lot more information on this time in our history because than I normally would, because what you have to understand is, and I would love like a raise of hand in the chat room, today's millennial buyers think that we're going to have another housing crash like we did in 2008. They're actually banking on it. I mean, I'll have millennial buyers saying to me, I'm not going to look right now. I'm going to wait for all these prices to crash and then I'm going to buy in a couple of years. And I will say to them, what makes you think that's going to happen? Because it's not going to happen. And what's making them think that is that it happened once before, and they know about the mortgage crisis. They know about subprime. So I spend a lot of time now educating buyers on what's so different from the mortgage crisis of 2008, which lasted in Connecticut, frankly, till about 2018, end of 2018, versus today, because they're two very, very different sets of circumstances, both challenging, both creating issues, but we have nowhere near the conditions that we had during the subprime crisis. So what happened is, you know, and if you ever want to know more about the subprime mortgage crisis, I really highly recommend the movie, The Big Short. If you watch the movie The Big Short, it's very entertaining. I actually can't watch it without crying because I lived through this. And it's just so devastating to it gives you a really good understanding of what happened on Wall Street that basically created it. Because the skinny down version or the watered down version is people couldn't afford to pay their homes, couldn't afford to pay their mortgages, foreclosures started. Those foreclosures led to people being worried about decreasing property values. More foreclosures led people to be worried about how low their property values were going to go. So then we got into something that was called strategic foreclosure. Not here in Connecticut so much, but I want you to think about like Arizona, where there's like a subdivision of 600 houses and they're all cookie cutter identical. And now people are being foreclosed upon. And you live there, and the house that you paid $500,000 for is now selling in a foreclosure auction for $200,000. If you're a homeowner, what decision are you going to make about your overall financial security? I always tell people, don't judge these people. Don't judge people who had to make decisions about strategic foreclosures because of their neighborhoods. Okay. And then what happens then? Now we go into a huge recession where unemployment does anybody know right now what the unemployment rate is in America? It's under 4%. I mean, that's one of the issues is we have such a hot labor market. During the subprime mortgage housing meltdown, our unemployment and underemployment, meaning people lost their full-time jobs and could only find part-time work, was close to 20%. And what's really staggering about that is that then meant 1 out of 5 American families who owned a home and had a mortgage no longer had enough income to pay those mortgages. Forget the subprime mortgages. We're talking about regular people who got regular loans, prime loans. Now we're in a great recession. We're at 20%, almost 20% unemployment and underemployment. And these families can't afford to make their housing payments. And at the same time, so then the foreclosures increased even more. So these you can see I'm getting so animated because this whole era was so difficult for us to be in. All right. So as I've said, subprime mortgages caused the Great Recession, caused unemployment, underemployment, caused more foreclosures. It was crazy. So what happened? The government stepped in with the most sweeping bank reform laws that this country has ever seen. It's called the Dodd-Frank Act. It was legislated by Barney Frank in Massachusetts and Chris Dodd here in Connecticut. And a lot of these laws were needed and they're excellent. And a lot of the laws, as is always the case, are onerous and swung the pendulum sometimes a little bit too far. So when you're thinking about your buyers or your sellers are thinking about their buyers who are getting a loan, and you might think to yourself, I don't understand why the lender is asking for X, Y, or Z. This is ridiculous. What you have to understand is today's lending environment is heavily regulated. There are huge penalties and fines to the lenders. And I'll give you an example of that in a moment. And what it means is that we're more restrictive and we have to perfect documentation. In subprime lending, there was no documentation required. You've probably all heard the expressions, no income, no asset, no credit. Well, today it's all about perfecting documentation. And as artificial intelligence has become more and more prevalent and more useful in mortgage lending and mortgage underwriting, Fannie Mae and Freddie Mac and all of the federal entities that are involved in mortgage lending now can have predictive analytics on who's going to be able to afford a payment and not. And that's what drives a lot of this. So I'm going to give you an example of a penalty to a lender so that you at least have an understanding as to why lending may seem stricter at times than you think it needs to be. So there was one of the laws that came out of the Dodd-Frank ruling was the TRID law. Basically, if you were around during this time, we now have new closing disclosures. You guys a customer used to get a what was called a HUD-1 settlement statement to reconcile their closings. Now they get a new document called a closing disclosure. And when the government decided to use that document in collaboration with a new loan estimate, used to be a good faith estimate, now it's a loan estimate, they locked in certain ways that lenders had to disclose fees and what they looked like at the closing. And this is because it was not uncommon for someone to get to their closing during the subprime crisis and find out the terms were nothing that they had thought they were or that had been disclosed up front. And now what happens to a client in that situation? They're sitting at the closing, they have no choice but to close and they're handcuffed. Well, this TRID law was supposed to prevent that, and it has prevented that from happening. But here's what happens when the government gives us a new banking law. They don't tell us how to implement it. And in the case of new laws, we will sometimes see lenders are interpreting it. They're setting up practices and policies around it. Sometimes they don't care and they're purposefully not implementing it correctly. Other times you have lenders who are working very hard to read the letter of the law and try to implement it. So there was a bank out in the Midwest, when this law came into place, they got a legal opinion from their attorneys, how they should implement the new TRID laws, they put it into place. The fine for not doing it correctly, it was $1 million, plus whatever discretionary fine the government saw fit. So this lender was deemed to be acting in an attempt to do the law correctly. They were deemed not to be, so they were levied with a fine of $1 million. In the chat room, and I got to see if I can get there, I would love you all to guess what you think the additional fine was. Got to keep you guys involved so that I don't put you to sleep. Anybody have any guesses? 1 million from Linda Amplo, 250,000. Yep. 500. Yep. Or 2.5 million. Good. I mean, those are onerous, right? All that money. The fine, in fact, for this particular lender was $10 million in addition to the $1 million fine. Now, I ask you, if you guys run your own businesses, how the heck is a lender supposed to protect themselves against that kind of discretionary fine? All right. So this is where a lot of these, a lot of our lending guidelines come from. And there's a lot of, and how we make decisions. All right. Now, let's see. Oh. And now my PowerPoint stalled again. Here we go. All right. The other sweeping law that came out of the Dodd-Frank law was that the government decided what were appropriate credit terms for a lender to be giving mortgages. It's called the ability to repay rule. And basically, the US government has now defined safe lending guidelines for lenders, okay? And I'm sure that you can imagine that sometimes when the federal government gets involved in some of these decisions, it's not always either easy to implement or easy to work with. So what they're basically saying in this ability to repay rule is that if a lender can prove that they gave the loan to a client under the terms of the ability to repay rule, then they've basically been deemed to be lending in a safe way. If they can't prove that, then there are additional potential issues where, and I'm gonna make this really watered down because it's a lot more complicated, but essentially a client can come back and say, this loan should have never been given to me. This lender didn't follow the ability to repay rule in the strictest sense, and therefore I don't owe them any money. And the rule allows for that. So the government has defined what's safe. Lenders are working to operate there so that they're not at risk, that a client will deem them as having lent money in a predatory manner. So what I tell everybody is getting a mortgage today is a two-step process. One is we want to make sure that people can pay the loan back. I mean, great lenders, great loan officers, we want to be giving good financial advice to families about buying a home and being able to afford that mortgage payment. But the second piece is the documentation has to be perfect. And so you may hear somebody, I know a common one is someone say, why do I need another pay stub? I gave you a pay stub. The dates of the pay stubs matter. How the pay stubs being reflected is matter. I mean, the documentation demands are rigorous and rigid as far as being followed. And if a lender doesn't document it correctly, then we could be forced to buy back the loan, which is very expensive. So, and the other thing that will happen, guys, that sometimes is you'll be like, wait a minute, I just closed a loan for a client last month and this wasn't required. Why is it required this month? Well, that's that artificial intelligence I'm talking about at work with all of the government entities. They'll start to identify someplace that's at risk for delinquency or for default. And now all of a sudden they'll add another documentation required. So it's fluid, it's never stagnant, and our information is changing constantly. But here's the really cool thing, okay? So with all this, like, oh, this is what it looks like, there are new technologies that have emerged, Prime Lending is using them, where if a customer can go on our online site and give us access to their bank statements, and through the automated underwriting portals, those bank statements can be what's called validated. And we can oftentimes get their asset information off it and validate their income. We have deals right now. They're not no income, no asset deals because we are verifying it, but we have access to go into using technology to go into these accounts. I was able to call a customer last week and say to them, and I quote, I don't need an appraisal, and we'll talk about that in a minute. I don't need any pay stubs, and I don't need any bank statements because everything validated through the access that they gave us to their banking accounts. So the great news is technology is making it easier and easier. These are not risky loans because we are getting the documentation. We're just getting it directly from the lending, from the banking institutions and making it a much easier step for the customer. So that's pretty cool. Okay. So as I said to you, I just went through this part with you already. Through Dodd-Frank, there's additional liability and responsibility for the lender. And what I always tell people is a common thing we'll hear from buyers is this, and you guys, I'm sure, hear it as well. I have an 800 credit score. What does it matter if I'm not showing enough income? Self-employed buyers, I have an 800 credit score. I've never been late on anything in my life. What does it matter? It matters because in the ability to repay rule, we don't have the ability to just rely on one piece, one factor in the credit evaluation, in the overall underwriting evaluation. We have to look at credit scores. We have to look at income and debt. We have to look at employment. We're going to look at assets, and we're going to look at the property. Those are the 5 key areas that we call layering risk, okay? And what that looks like, right, is if somebody has an 800 credit score, but maybe their debt to income ratio is a little bit tighter, they're going to have a greater chance of getting an approval than the exact same borrower with the exact same income who maybe has a 640 credit score. So there is, it's called the opposite of layering the risk is compensating factors. What's good about the file that lifts up our ability to underwrite it. And that's a big piece of what we do when we evaluate the file. Now, let's see. Okay. So I'm going to go through these 5 things with you so that you have an understanding of them. Again, if you have any questions, you can always pop it in the chat section. So the first piece, which most people think is the most important, is credit and credit scores. And what it's really important that you understand about credit is credit demonstrates a willingness to repay your debts, okay? Not necessarily the ability to repay, but willingness. We've seen people who make very little money, who have never had a late payment in their whole life, because they will sell their personal belongings before they will go late on any kind of payment. Conversely, we've seen credit profiles of millionaires who decide not to pay their bills on time, and who completely have the ability to do it. So it's important to understand the reason credit's so important is because it's a behavior. Credit, how you handle your credit profile, how you pay your bills is a behavior and is a big indicator of your forecast on whether you're going to make your payments. Okay. Now, credit scores are, of course, everybody now knows about credit scores and how important credit scores are. It's important for you to really, really understand that, yes, we need to know what the credit scores are. Yes, the credit scores are going to impact your interest rates, your mortgage insurance rates, and how we underwrite the loan, but we're also reviewing the body of the credit report. There are cases where someone can have a perfectly acceptable credit score, but there are things in the body of the credit report that preclude us from being able to lend on the loan. So like kind of, I want to say newer loan officers who haven't been trained as lenders, they're just looking at these credit scores and issuing pre-approvals real fast and getting caught. I know, because I rescue these deals on issues that were present in the body of the credit report that they didn't look at. So you want to be careful about just relying on credit scores. So it's important to understand that we deem poor credit as a credit score that's under 660. And by poor, we just mean this is where underwriting is going to be stricter. This is where interest rates are going to be higher. And we can lend down to 580 with restrictions. Okay. So if you're lending between 580 and 620, somebody with that, there's going to be more restrictions on how we'll do that loan. Good credit scores are usually considered between 660 and 720. And then anything over 720, I would say is excellent. Okay. Now, it's interesting to note that per HUD, FHA loans, which is an important first-time homebuyer loan, they're 4 times more likely to go delinquent or default with a credit score under 640. So the reason that we put those restrictions in place is because we want, again, it's lending responsibly. We want to make sure that those people who've got lower credit scores have the additional support of a more affordable payment so that they don't wind up getting into trouble. Now, we'll do another chat. How many, if you're tracking your credit score, or your buyers or sellers are tracking their credit scores on Credit Karma, are those scores accurate, and are they usually what we see in the mortgage industry when we go to pull? No, correct. No, big N-O. So what's important to understand, and people and consumers, again, hate this. Buyers today more than ever don't want their credit scores pulled. There's this wave of like doing soft credit pulls that are starting to sweep the mortgage industry. But it's important to understand that there are different credit scoring models. And depending on the cost of the model, it depends on how much information is loaded into that credit scoring model and what you're going to get back. So if somebody's tracking through Credit Karma or Capital One, which is a free credit report to the consumer, obviously they're working with the lower cost credit scoring models that don't do a lot of work and analysis in developing the score. Mortgage lending, we use the most expensive credit reporting model because that's the one that does all the detail and all the analysis and gives us a far more accurate credit score. It is not uncommon, guys, and this is important for you to understand because I know your buyers tell you so much stuff, so please hear me on this point. It's not uncommon that Credit Karma scores can be 80 to 100 points higher than a mortgage credit report. So if you're starting to talk to somebody and a family or a young, you're talking to anybody and they say to you, we're really good, our Credit Karma score is 640, that should be a warning sign for you that you need to get them in the hands of a reputable lender as soon as possible, because there's a pretty good chance they're going to fall under the acceptable lending limits. And they don't know. And this, it's infuriating to home buyers. It's infuriating that their credit scoring models are different, but it is the reality of the situation. So if you talk to somebody and they tell you that their credit scores are lower, please be sure to get them in the hands. Now, there's companies like Prime Lending where we can, if we have somebody whose credit score is not satisfactory, or let's say we get somebody who's got a credit score of 719 and we know interest rates get much better at 720, we can run what's called a credit simulator to see if there's any quick fixes that someone can do to raise their credit score. Okay. And that's a great feature that we have because it allows people the ability to make a quick adjustment and get their credit score up. If you guys were going to guess, what do you think is one of the things that people could do to get that? What do you think is a quick thing that often people can do to improve their credit scores? Any ideas? Yeah, lower credit cards. Can you, I'm just looking at these questions now. So can you touch on what is the report you run as opposed to what is the Credit Karma report? I mean, Matt, you know what? You would think I could tell you that. I can't. I'm not sure what Credit Karma uses, and I'm not even sure because ours constantly change what the actual definition is. I can get back to you with that. I mean, it's on the report that I read every single day. I just don't know it. So I'll definitely get to that. myfico.com is similar to credit, is similar to any of the free annual reports. You're going to see typically lower scores when we go to pull their mortgage. It's recommended that people should check their credit scores once a year. I would say if somebody's really working to improve their credit scores, it may make sense more often than that. I will tell you this, if someone is really looking to do credit repair, I highly recommend they work with a reputable credit repair company to do that, because I've seen so many people make big mistakes. And I'll tell you the number, I'll tell you I'll first respond to the credit card balances, and then I'll tell you what a big mistake is that people make that winds up hurting them for 12 months. So the first thing is credit utilization is a big piece of what goes into credit scoring. What's your available amount of credit? What's available to you in credit, and how much have you used? How much have you utilized? And different credit reporting companies will tell you different amounts, but anywhere between 10 to 30% utilization helps your score. Typically, anything over 30% starts to degrade your score. One of the other things that crushes your credit score when it comes to balances is if somebody has a $5,000 credit limit and their current balance is $5,100, it can have a huge impact on their credit score. So when we run those credit simulators, oftentimes it'll come back and say that $5,100 that's against a pay down to $4,990, and we'll get a significant lift on score, like 20, 30 points. It can be really dramatic sometimes. The number one mistake buyers make when they're doing their own credit repair has to do with collection accounts. And let me just go forward because I'm just talking without my slides, and I'm probably, okay. Has to do with collections, all right? So after a collection, so let's talk about the difference. So a collection, because I know all of you have perfect credit and you've never had a collection account. A collection is when you haven't paid your bill and either the creditor is trying to collect the money or they turn you over to a collection agency, right? That's a collection. A profit and loss is when the creditor has decided they can't get the money out of you and they've written it off. And a judgment is when it's something like a delinquent tax bill, and the creditor is actually able to get the court to assign a judgment, which stays with you as well. So when it comes to collections, what most people don't realize is if a collection is over 12 months old, it actually does very little harm to your credit report anymore. It ages away from impacting your credit score. The single biggest mistake buyers make, so let's say we're looking at a credit report and somebody has a $500 collection account that's 2 years old. They get their free copy from Credit Karma, wherever they're going to get it. They see it's a collection. People know collections are bad. They go and pay down that collection account. Well, what happens is the timing of that debt tags to the last activity. So when someone pays off an old collection account thinking they're going to improve their credit scores, the opposite happens because now there's activity on a collection account within the last 12 months. And I've seen people, I had one woman who did it and it dropped her credit score by 60 points, 60. She was devastated. Nobody told me. I never talked to anybody. She's been pre-approved by another lender who told her to do it. I mean, it was absolutely devastating. So it's so important that I think if it was a family member or a friend of mine who wanted to do credit repair, I would put them in the hands of a great credit repair company and let them do it because they understand how these models work and they know what works and doesn't work. Another big tactic that was taking place that's now been creating a problem is what's called disputed accounts. So as a consumer, you have a right to dispute derogatory credit on your credit report. And when you do this, what happens is the credit scoring model takes it out of your credit scoring. So if you've got somebody who just had a 90-day late payment on their car loan and they're disputing it, it takes it out of the credit scoring model. Now, credit reporting companies several years ago got hip to this trick and they were putting disputes on everybody's credit report. Well, then Fannie, Freddie, and FHA got hip to their strategy and basically changed the automated underwriting models to essentially reflect that you really, in most cases, can't have more than one disputed account, if at all. And they force us to lift the dispute. What happens when somebody lifts the dispute? Of course, at that point, their credit scores drop again. So really understanding credit repair is so important. And again, can't say enough that it needs to be done by a professional. What's important to know when we're looking at derogatory credit is that short sales, foreclosures, and bankruptcies all have mandatory waiting periods, depending on the loan program, for how long it's been since those significant events took place. And what's really important for you guys to understand in Connecticut, and thankfully we're timing farther and farther away from this, but I do think as realtors you need to know this, is Connecticut is what's called a judicial foreclosure state. Most of you know this already. It's very hard to foreclose on a buyer, on a homeowner in Connecticut. We have very strict laws against lenders for foreclosures. As a result, I'm sure all of you have heard stories of somebody whose house was, somebody who filed bankruptcy, they stopped making their payments, or their house was going into foreclosure, but they lived in the house for another 2 years or another 3 years. Luckily, our foreclosures we've timed away from a lot of these, but what you have to understand about Connecticut is this: the waiting period for a foreclosure is longer than the waiting period for a bankruptcy, and they're two separate events. So there were a lot of Connecticut residents who, because of the subprime crisis, were forced to file bankruptcy, and who thought that when they filed bankruptcy, their foreclosure took place at the same time. And that's not the case. So when you were dealing with people in Connecticut who filed bankruptcy or who've had a foreclosure, we're always having to educate them on those two different waiting periods. Okay, but it is an important distinction. I think there's only 5 judicial foreclosure states in the country, and we're one of them. Does anybody have any questions before I go on? Do you recommend closing credit cards that are not used? You're getting me with all these questions. So the credit reporting models will say that it's better to keep a zero balance card open because it positively affects your credit utilization score. So the recommendation typically is don't close them. Where we've seen problems, and we've actually had to use zero cards, is it's not uncommon for someone to, let's say they've got $5,000 in total credit card debt. And now a credit card company comes out and says, great news, I'm going to give you 0% interest for the first year. And we're going to give you a $5,000 limit. So they transfer all their small credit card balances onto this one card with a $5,000 credit limit. They've got a $5,000 balance. What happens? Their credit utilization score gets impacted and their credit scores go down. So when we'll run the credit scoring model, it's not uncommon that the model will simply say, take $5,000 off this credit card and spread it to these 5 credit cards, and your credit score will go up significantly. So there's definitely ways that that gets impacted. Okay, let's see. Can a retired person borrow with excellent credit, but lacking in income and assets? The answer to that is it depends on their age. And we'll get into this a little bit, Laura, as we go on. There are some programs out there specifically geared toward people who are 62 years and over. It's the reverse mortgage. That's probably the program that would give somebody in that situation an opportunity to be able to borrow money. But to not have any income or any assets is going to be really difficult. Yeah, and some banks also have a service to show your FICO score, correct. Experian Boost, we haven't really seen a lot of success with it yet. It's fairly new, Laura, but you know, that's all kind of like Experian trying to do some credit repair and credit simulation as well. But in that case, it only impacts the Experian score. And we're always, I got doorbells ringing and phones ringing here. I'm so sorry, guys. And in that case, you know, when we're doing our simulator, we're looking at all 3. We pull from all 3 bureaus. And so because of that, we may be able to see a better benefit than just somebody doing simply Experian Boost. Okay. All right, let's talk about income. So income demonstrates an ability to repay, right? That's, I have enough income coming in to pay my bills. So what's important to understand about qualifying ratios is this. Until the year 2000, we had to manually run qualifying ratios by hand. And so there was always 2 ratios we looked at. The first ratio was the total mortgage payment. So what we would do is take a look at the principal and interest, property taxes, homeowners insurance, condo fees, if any, mortgage insurance, if any, that total payment divided by total gross monthly income that's verified should not exceed 28%. So if you ever heard the old rule of thumb, like your housing payment should always equal one of your weekly paychecks, that's where that came from, okay? Then what we would do is take that housing payment, that new mortgage payment, proposed mortgage payment, plus car loans, student loans, credit card payments, those types of installment debts that come up, or credit card debts, revolving debts that come up on a credit report, and that ratio should not exceed 36%. This was the most restrictive lending in the history of America. Those ratios of 28, 36, and I'll explain to you why I'm emphasizing that. During the subprime years, during 2000 to 2008, we were seeing people get approved with 100% ratio. That's that no income, no asset thing that was going on, okay? Today, we have a different approach. Typically, and we're not, in most cases, we're not looking at the single housing payment front, we call that front end ratio anymore. We're looking at the total ratio. This is called your DTI, or your debt to income ratio. So if a lender's saying to you, their debt to income ratio is too high, it means the amount of debt that they carry compared to their income is too high. Now, under 38%, we consider that conservative. 38 to 43 is considered acceptable. And once we get to 44 and up, and we can go up, we call that stretching. We're starting to stretch somebody's qualifying ratio. So let me talk to you about these three kind of like brackets and how it translates into financial conversations with customers. So you will get a buyer sometimes, you guys have had them, who are incredibly conservative, and they're so afraid that they're not going to be able to afford their mortgage payment. Maybe they've been living home with mom and dad all this time, and now all of a sudden they're looking down a $2,800 mortgage payment, and they're thinking they can't afford it. Well, I always know when I'm having my financial call with them, I always know what their ratio is. And if I know their ratio, their debt to income ratio is 38% or less, I give them the same little presentation I just gave you. Look, in the most conservative that we've ever lent in the history of America, you would have received the loan. So, this is very, very conservative. When we're stretching somebody's qualifying ratios, and sometimes this provokes a reaction when I'm talking about it from real estate professionals. Well, you shouldn't do that. That's what caused the subprime mortgage crisis. But let me stop for a second. There's legitimate places where we need to stretch somebody's qualifying ratios, and for good reason. And what I believe, in order to be a responsible, ethical lender who's lending with empathy and making sure that a customer can afford their payments, is you dig deeper on affordability. So it's important to understand that, sometimes you've got a couple, and before the couple got married, maybe one of them struggled with credit and has a really derogatory credit score that doesn't allow that spouse to be on the loan, right? But we know that spouse makes all this extra money, and we're trying to now qualify using one spouse. That's an example of where we're stretching somebody's qualifying ratios. We know, as the loan officer, I feel comfortable lending responsibly, stretching that ratio, because I know there's extra income. I had a case last week where I had a young woman buying a house. She's lived with a roommate her whole life. The roommate's going to move in with her. The roommate's going to pay her boarder income. I can't use boarder income to qualify. It's not allowed. But I now know this girl's going to be getting $1,200 a month. That is additional income to help her qualify. We're stretching the ratios. And of course, probably most notably is when it comes to self-employed borrowers. Remember how I said we use gross income to qualify? Well, the only exception to that is self-employed borrowers. We use their net income off their tax returns. And what do we know most self-employed borrowers are doing? Of course, nobody wants to pay more taxes to the US government, so they're writing off a lot of expenses. So stretching qualifying ratios is something we also typically do when we're working with self-employed borrowers. So just really important to know that just because somebody's debt to income ratio is high doesn't necessarily mean it's unaffordable, but it's our responsibility to know that. Finally, it's important to understand that if somebody has lower credit scores, they're going to be held to we're not going to have as much opportunity to stretch as we can with somebody with better credit scores. There is a definite correlation between credit scores and debt to income ratios. The higher credit score, the more we can stretch, the lower, the less we can. Okay. And we've even seen people with credit profiles, like if we're really trying to underwrite somebody in that 580 range, we can see those debt to income requirements be even under the 38% that's considered most conservative. Again, that's what I said. We want to prop those people up and put them in a position where they can be successful. And what's really important to understand about income is you have to have typically a 2-year history, and we have to be able to show it's going to continue. So I have a woman right now we've been trying to qualify. She's 4 months shy of having a 2-year employment history, and we're basically like she's gonna probably have to wait until she puts the full 2 years under her belt in order to get financing. The reason continuance becomes so important is because continuance it's not like, is your job guaranteed? We're not looking for that on an employment situation necessarily, but what we do require a continuation on, which gets a little difficult sometimes, is especially in alimony and child support. So when it comes to child support, for example, we've got to be able to show that child support is going to last at least 3 more years if we want to use it to help somebody qualify for a loan. So always understand there's a history and a continuance component to evaluating income. These are some of the types of income that we can use. To your question about retirement, if somebody has a retirement account, a large retirement account, but they're not actually drawing on it, we can actually use that retirement fund as income sometimes if we need help with the debt to income ratio, even though they're not drawing on it, because we know they have the ability to draw on it. So there's all sorts of great things that we can do to help people get qualified in this evaluation. I'm just going to check the chat, make sure I don't have any questions. How do you stretch for self-employed? Okay, let's go back up. Let's see. Okay, so I think I answered this, right? The retired person would probably have to be looking at a reverse mortgage. DTI is sometimes a problem for real estate investors who own several rental properties. They have rental properties generating income, but DTI is not favorable. Correct. Because if you're same thing with a self-employed borrower, if you're writing off a lot of expenses on those properties, we're going to be taking those expenses in and using net income as well. So that is correct. How do you stretch for self-employed excellent credit? So the first thing is, if they have excellent credit, it's not uncommon that we'll be able to see those back-end ratios go up to say 49%. The other thing that's important about self-employed people is that there are certain expenses on their tax returns that we can add back to income. So if you've got somebody who owns a trucking company and they're writing off a ton of depreciation on their trucks and equipment, and I've evaluated tax returns for a trucking company where that was a 6-figure expense that was reducing their tax exposure. I can add that expense back in. So knowing which expenses we can add back into a self-employer also allows us to help maximize their qualifications. Okay. Employment, it's what we've said. We always want to see history and continuance. We can use multiple jobs. We can use part-time jobs. We can use self-employment, but I'm going to tell you for all 3 of those things, you need a 2-year history. And when I say a 2-year history, in the case of a self-employed person, it means you're going to need 2 full years tax returns. So that 2 years might actually be longer than 2 years, depending on when the tax return cycle is. This is the time of year right now where if I'm having a hard time qualifying somebody who's self-employed, we'll usually have a conversation that says, they'll say to me, well, if I knew this, I wouldn't have written off all these expenses. And I'll say to them, look, we're almost at the end of the year. Let's get your taxes done really early. If you want me to take a look at what your income would be with you reducing your expenses this year, please get me a copy of the draft of that, and we can absolutely take a look at it. But it's important to know that they need 2 years tax returns. Debts. What debts are we taking into consideration in that debt to income ratio? Mortgages on other properties. If somebody owns a second home, we're taking auto loans, auto leases, credit cards, personal loans, student loans. Okay. Now, when it comes to student loans, this is probably one of the biggest challenges we've had in recent years qualifying people for financing. We basically, if we can, so let's say we're doing a loan for a young recent grad and their parents make the student loan payments. If we can verify 12 months of the parents making the payments, we don't have to hit the first-time buyer for it. Conversely, if we're doing a loan for the parents and we see the student loans on the parents' credit report, conversely, if we can prove their child has been making payments for 12 years, we can do that as well. We can not count it against their debt to income ratio. When it comes to deferred student loans, and this has been a big thing in the last 2 years, what you need to understand is just because a student loan is deferred doesn't mean we're not calculating a monthly payment. And this is often shocking to people that we have to, like, but you're going to have to make a payment at some point. We've got to make sure you're going to be able to afford it. And then finally, we do have a program that we're just launching that we can offer to clients who have a lot of student loan debt, where they can subscribe to this program for federal student loan debt, and they can go in, because it's so hard for people with student loans to figure out if there's a way that they can reduce their total monthly payment on their student loans. It's like, it's just very difficult to work through the student loan administration to figure this out. So there's a new third-party source that we're offering our clients, because they can go into their student loan evaluation and let them know what they can do to come up with a lower monthly payment. And if they can do that, we get to use the lower monthly payment. I've taken people who had there was a Yale nurse practitioner I was doing a loan for. She had a monster student loan debt. It was over 6 figures. She went to Yale, and she was in deferment. So I had to calculate a huge payment on it. She qualified for something called income-based repayment, where because of the profession she was in, if she got approved with this program, she didn't have to make a payment. And if you're in that program and you don't have to make a payment, I don't have to use it. So we got her working, we got her into the income-based repayment plan, and we were able to qualify her for her house. So lots of things, again, in the hands of a great loan officer who knows how to do all this, there's a lot of things that we can do to help people qualify. Assets demonstrate fiscal responsibility, right? Have you been able to pay your bills and save some money? Essentially, it's important to understand that we're always going to look first and foremost at borrowers, what we call own funds. How much has the primary borrower or the occupant borrowers been able to save? We look at bank accounts, retirement accounts, stock accounts. Okay, we typically, right now, it's usually, depending on the loan program, we need either 1 or 2 months of bank statements. We're going to always track large deposits. That's required by the Patriot Act and the anti-terrorism efforts of the U.S. government. If we see large deposits going in, we're going to need to find out where that money came from and find a paper trail of it. And then secondly, it's really important for you to understand that when we're dealing with buyers today who have cryptocurrency, I don't know if anybody here owns crypto, but if you do, you know you don't get statements. And it's one of the hallmarks of crypto, right? Is the privacy and secrecy factor. Crypto is very hard to document, very hard to document. So a lot of times when we're talking to people and all their money's coming out of crypto, we'll sometimes advise them, get the money out, get it into an account and let it season there for 1 or 2 months, because it's going to be really hard to verify it. And basically, if we can't verify it, we don't get to use it. Same thing is true for cash. True cash on hand, very difficult to document. There are times that we can use it, but we've got to be able to demonstrate. We've got to be able to demonstrate it. It was very common during the pandemic for certain cultures. I saw a lot of this, to take all their money out of the banks when the pandemic hit and put it in cash, like in a cash box in their house. And if we were able to demonstrate that, we were able to show the cash going back into their accounts, we were able to use it. But there's usually got to be a reason failed. They didn't believe in banks in that culture. She wrote a letter to that extent, and we were able to use the cash. So it's got to make sense. Gift funds are acceptable. Gift funds from, they typically have to be from family members, but this is getting a little bit looser too. If we can show that a friend has a vested relationship, there's now some looser guidelines, but typically gift funds, we're looking first and foremost to family members, and we have to document that. So if mom and dad are going to give their young couple $20,000, we're going to need to see the $20,000 coming from mom and dad to the couple, and depending on the loan program, we may need to see a bank statement from mom and dad showing they have the $20,000. Okay. And then for those of you who've been in real estate for more than a couple of years, you have to know about seller paid closing costs, seller concessions. This is a strategy that we employed on the majority of first-time homebuyer loans leading up to the pandemic and the current seller's market. And what the seller paid closing costs do is it allows for the seller to contribute money towards the buyer's expenses. And what I always tell people, the way you figure out like what somebody's total closing costs are, hard closing costs, you're probably looking at about $5,000. It's probably more like $5,000 to $6,000 today. We're going to always use 14 months homeowners insurance and 8 to 9 months worth of property taxes. We combine those three things together, and those are all allowable fees that a seller can pay. Now, this really important strategy to help buyers who haven't saved enough money for down payment and closing costs has become a real problem because in today's market, sellers haven't been accepting them. I just need to. Okay, sorry about that. So as a result, it's kind of cut people out. I will tell you this. Just like I used to sit in training in 2018 and 2019 and talk about what the market would look like when we reverted back into a seller's market. Similarly today, we will go back to a market where we need seller closing costs. And I'm going to actually give you an example at the end of this class on why you might want to be thinking about this now when you're talking to your sellers and you're at the time of the listing. Okay. Okay. Property. And again, if you've been selling houses the last 2 years, this was something no one ever understood. And now we got this hot seller's market. And what were we always worried about the last 2 years? Was the house going to appraise out? Was the house going to appraise out? Lending guidelines are based on the purchase price or appraised value, whichever is less. I've got back feed now. All of a sudden, somebody's speaker might be on. And PMI, or private mortgage insurance or mortgage insurance, is required whenever there's less than 20% down. Now, new phenomenon that I had not seen in my career: millennials hate mortgage insurance. They hate it. They think it's unfair. They get angry about it. But it is required. It's always been required. And what mortgage insurance is, guys, is an insurance that the borrower pays that protects the lender against default. Not against default, but it minimizes the lender's financial losses in the case of a default or delinquency. So it's a necessary evil. You guys know this better than I do. We're going to always take a look at 6-month comparable sales, 6 months backwards. That's why we were seeing some challenges with appraised values over the last 2 years, because property values were going up. They were going up faster than the comparable sales could keep up with. And you guys know better than I do that, appraised value was a concern. The other thing that's important to understand is we're always going to be focused on the condition of the property, right? This is especially the case for FHA and VA loans, but also important even on conventional loans. We're going to want to make sure that there's nothing harmful in the property that could cause the client harm, and then ultimately have them turn back and say, I should have never been allowed to finance this house. So I want to talk for a minute about the difference between, and this has never been more important and kind of more of the hot topic than it is today, the difference between a pre-approval and a pre-qualification. So what I need everybody to think about for a minute is I want you to completely ignore what a lender's letter says. All right. Let me tell you, a pre-qualification is when a loan officer has done some level of evaluation up front on the file to determine if the client qualifies. And that pre-qualification is only as good as the loan officer who's doing it. So it could be as little as them running some numbers and telling the client they're all set. And by all set, I mean their letter may even say pre-approved, but essentially what you're dealing with is a pre-qualification. I've taken loans in over the last 2 years with pre-approval letters that were issued by some of the large New York banks, by some out-of-state banks, pre-approved. Credit had never been pulled on these clients. These clients were in contract. They go back to their lender. Now the lender starts doing the work. You guys know, you've been dealing with this, right? With lenders that, client thought they were pre-approved and then found out that they weren't. When I'm doing a pre-qualification, I'm pulling credit. I'm still looking at income. I'm still looking at assets. I'm running the loan through automated underwriting. So we do a very thorough job if we're doing a pre-qualification. A true pre-approval means I've put the loan into my underwriting department and a human being has underwritten the file. That's what a true pre-approval is. The reason I tell you not to pay attention to what the letter says is there's a lot of lenders out there who are calling their pre-qualifications pre-approvals. So I think it's been so great the last 2 years because I get calls all the time from listing agents now when my clients are making an offer, and I'll sometimes even call them ahead of time. And they're saying, I just need to understand, is this a pre-qualification? Is it a pre-approval? How much work have you done? And I think that's like the best thing that's hit the business to help protect your sellers against these pre-approvals that are done really poorly, really poorly, pre-qualifications. General rule of thumb, and this, guys, I hate to tell you, has actually gone up recently, but a general rule of thumb for you to know that every $10,000 in financing, it's actually about $65 a month right now. So I'll have clients call me and say, hey, I really want to drop my mortgage payment. So I think I'm going to put an extra, $10,000 down. And they're always horrified to find out that it's only going to save them $65 a month. That's because we're amortizing this debt over 30 years. Similarly, a lot of times if your client is negotiating and they're like, I can't afford another $10,000, I always recommend you put them back in my hands, because I'll say to them, we're talking about $65. So stop thinking about 10,000 for a minute. We're talking about $65 a month, like Starbucks, Friday nights out at the bars. Like there's places we can find $65 a month if that $10,000 is going to make or break you getting the house of your dreams. So this is a really good rule of thumb to know when you're talking to customers, because again, they can get fixated on the amount and not necessarily understand how it translates relative to monthly payment. So these are some of the loan programs. Okay, and I'm going to skim through this stuff, but just, I'm sure you guys know a lot about this. Conventional loans, right? This is the gold standard loan that we use in America today, are sold to Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac dictate the underwriting terms. You have to have a minimum credit score of 620. You can typically, first-time buyers or income-restricted buyers, people with lower incomes, can sometimes get in with as little as 3% down payment. Otherwise, it's a 5% down payment. Those seller concessions that we talked about, where the seller is going to pay some of the buyer's closing costs, those are limited to 3% of the purchase price, unless the client's putting 10% down. They tend to have tighter ratios. And the big news is the announcement just came out within the last 30 days that the new single family loan limit for a conventional loan is now $700,000. That's now 10 times higher than the year I got in the business. When I got into the business, it was $70,000. We now consider a conventional loan of $700,000 or more. Multifamily properties, three units and up, over $1 million minimum, maximum loan payment. So that's been great news. FHA loans, our poor FHA loans during this market, right? We've got so many great FHA buyers, and the sellers have, been able to cherry pick and not necessarily look at FHA buyers at this point, even though they're great clients who are very well approved. They can have fair to great credit. They are always required to have a 3.5% down payment. Great news on FHA loans is we can go to 6% of the seller paid closing costs. We're definitely more flexible on ratios. We're a bit stricter on property conditions. The big news about FHA loans, and it's starting to get some publicity now, is they're assumable. So let's talk about all our clients who closed on FHA loans at 3.25% back in 2000, 2001. And now it's 2025 and they want to sell their house and interest rate, well, not 25, it's 2022 and interest rates are at 7%. There's a chance that they could have their buyer assume that loan. Now, the problem that we have is you can only assume the loan up to the original loan amount, up to the current balance of the loan amount. And depending on how much equity there is, we haven't seen home equity line lenders come in and fill up that gap. But the industry is paying attention to it now, and I would expect lenders to be coming out with an opportunity to get second mortgage financing to fill that gap. So it's kind of a cool thing about an FHA loan. People typically bristle on FHA loans because it's more expensive relative to the mortgage insurance. There's an upfront mortgage insurance premium that is not paid out on a conventional loan, and the mortgage insurance premium on an FHA loan stays on for life. Where on a conventional loan, it drops off when you have 20%, essentially 20% equity. It's more like, depends, but let's call it 20% equity. We don't know what the maximum loan amounts are going to be yet in Connecticut. They vary by county. For 2022 was 420, so much lower loan amounts. FHA lending is typically geared towards improving home ownership, so it's often considered a first-time home buyer program. VA loans, similarly, our poor veterans who are using VA loans have had a hard time getting their VA pre-approvals accepted. VA allows us to do zero money down. You must be a veteran or married to a veteran. So guys, I've had 2 cases in my career where I had to send a young couple down to town hall to get married because they needed the wife's income, the fiance's income to qualify, and they weren't married yet. Can't go on a VA loan if you're not married to the veteran. Their families to this day still don't know they got married ahead of the weddings. We're very flexible on ratios and, weird little like mortgage fact, you have to include daycare in their ratios. It's the only place we have to do that. CHFA loans are the Connecticut Housing Finance Authority. These are first-time home buyer programs. They're geared towards low to moderate income families, getting a lot of publicity right now because they've had the time to own program where people can get down payment assistance up to a $50,000 forgivable grant. It's been really difficult to qualify people into that program, but it's something that the state did step forward with. They've got income caps, they've got purchase caps, but they will allow us to let a client borrow up to 105% of the value of the home towards down payment and closing costs. Okay. Really important to understand that on CHFA loans, they are very strict on occupancy. You absolutely positively must occupy that property for as long as you have that loan. If you decide you want to, go on and buy another house in the near future, at some point in your future, and you want to try to keep this for a rental property, you have to refinance out of the CHFA loan. So if I have anybody who's talking about doing that, I won't even consider CHFA for them. USDA, not that popular here in Connecticut because we don't have a lot of it, but if we do have a property that's located in a rural area, we can do up to 100% financing. Jumbo, well, I didn't change my slide here, guys. It's for loans over 700,000. Jumbo loans are much stricter in underwriting than non-jumbo loans because they're not protected by the U.S. government in the ability to repay rule. So I always say we have completely different guidelines for jumbo loans than we do for other loans. Just important to understand. Renovation loans, my favorite. I did a lot of renovation loans in 2018 and 2019, done some renovation refinances in the last couple of years. We took a Cape, converted it to a Colonial. Kind of an important loan program to understand in the inventory crisis we have because there's a lot of things that people can do using renovation loans. Important to understand that a renovation loan is one loan program. A lot of times buyers think they get their traditional mortgage and then like money for renovation. It's one loan program. But if you've got somebody and you're having a hard time finding them a house, I know that there's like something like 50% of the inventory that's on the market right now has been sitting there for a while, and it's usually distressed properties or properties that need work. Definitely worth taking a look at. Like I said, 2 deals this year, we converted capes into colonials. So a lot of great things that you can do using renovation loans. All right. Where are interest rates going? Right. This is a $1 billion question in America today. What's going on with interest rates? Why have they gone up, and where are they going? So let's talk about this. Okay. So what's important for everybody to understand is that, and most people forget this, in the early weeks, 2 weeks of the pandemic in March of 2020, the financial markets were crashing. Okay. Nobody knew it was going to happen. The government was shutting down. Nobody knew it was going to happen. And the markets were crashing. The US government stepped in only the second time in history to prop up the housing market and the mortgage market, and they started buying mortgage-backed securities. At the same time, and that was a really important step for them to kind of take care of it, because otherwise the fear was mortgage-backed. So mortgages are sold in the open, in the secondary market and in Wall Street. If you don't have somebody willing to buy a mortgage-backed security, a lender can't lend. So the flow of money through that financial wheel is critically important. So the government basically became the single largest purchaser of mortgage-backed securities. The only other time they did this was during the subprime mortgage crisis. Secondly, the Fed became worried about the economy and businesses that were going to be forced to shut down during quarantine. And what did the Fed do? They dropped the Fed funds rate. Now, typically, what happens with the Fed funds rate does not immediately impact mortgage rates, okay? As a result of that, you saw the historically low interest rates that we had in 2020 and 2021. And then here's what happened, guys. In November of last year, 2021, the Fed made a surprise announcement that they were going to stop purchasing mortgage-backed securities. So in November and December and January, we saw the first big spike in interest rates, and that's what drove it. Secondly, all through 2021, the Fed kept talking about inflation and how inflation was getting out of control and that it was transitory. It was being caused by the pandemic. And that is true. Okay, they've since dropped the word transitory, but it's important to understand that inflation is a global issue right now. Canada has high inflation. Europe has high inflation. America has high inflation. And all of these countries are changing banking and monetary policy to try to handle the fact that we've got inflation, due primarily in America to 2 things: supply chain issues. Right, there's still parts of China that are closed where we're not getting goods and products that we're expecting from China. I think Shanghai was closed as recently for like 4 months, as recently as a couple months ago. Thousands and thousands of containers of goods that we need in America to curb prices going up, inflation going up. That's not happening. So that's the first reason. And then you've got a very, very hot labor market. Unemployment is very low, and you had a very hot housing market. You combine that with the war in Ukraine, which put additional pressures on prices of food and gas, fuel, food and fuel, say that 10 times fast, and we wound up with skyrocketing inflation. So what is the Fed? You guys hear the news all the time. What does the Fed say? All they care about is curbing inflation right now. That's what they're going after. And that's what all these rate hikes are for. That's what all these rate hikes are for. They're going to get inflation. They're going to calm the economy down. The economy is too hot. Consumers are paying too much money for goods and services. They're paying too much money for housing. And so the Fed wants to slow it down. Now, there's a lot of debate on whether the Fed can do this gently. They call it a soft landing, and not stick us in a recession, or whether they're going to plunge us into a recession. News came out yesterday. We had growth in GDP. That was a surprise. So no, that's where we determine whether we're heading into a recession or not. So we'll see what fourth quarter does, but it was kind of a little reprieve on the recession news yesterday. But what's important to understand about mortgage rates is that mortgage rates follow inflation. So if you look at this chart that I have on my screen, and guys, next week I will send you this presentation. So if you want to use these charts, you can. But if you look at this since, before 1980, you can see where inflation goes and that mortgage rates follow, okay? The only real big blip in this you'll see is 2008, okay, where that changed a little bit, and that's because the Fed stepped in and started buying mortgage-backed securities. Otherwise, we follow inflation. So here's what I keep saying to every buyer I talk to, or every potential buyer I talk to. Yes, mortgage rates are around 7%. They may get a little bit worse before they get better. Now, Yolanda and I were talking up front. The first mortgage rate, guys, I ever closed for a customer was a fixed rate at 17%. That tells you how much gray hair is under all this blonde hair of mine, okay? 17%. Adjustable rate mortgages were basically developed because nobody could qualify at 17%, and now you could qualify at 14%. Through most of history, mortgage rates ranged around 8%. There is a chance we will see 8% early this year, okay? But what do we know? What I said to Yolanda is our millennial buyers don't care. I was trying to have conversations with our millennial buyers about how, historically rates are around 8%. They don't care. All they know is where rates were in the pandemic. And I'll say to them, those are artificially low rates. We don't care. That's where their focus is. And so here's what I say to everybody. Mortgage rates follow inflation. When inflation's going up, mortgage rates are going up. What do we know for sure? And I haven't been able to say this except one other time in my career. We know for sure that the Fed is doing everything in its power to what? Bring inflation down. What will happen when inflation comes down? Mortgage rates will come down. The expectation is that we will see mortgage rates in the high 4s, perhaps low 5s, sometime within the next 2 years. In 2 years, we have some analysts predicting first quarter of next year. I personally don't think it's going to be that fast, but that's what some analysts are predicting. The other thing that's important for you to understand, and this is happening right now, the Fed is meeting next week. And what am I getting? All these panicked phone calls from people who are, making offers on houses, but they can't lock their rates in because the rates are going to go up 3 quarters. No, they're not. The rates are not going to go up next week 3 quarters. What the Fed is planning to do in November is already built into today's interest rates. The mortgage industry isn't going to wait until the Fed makes those changes. We're going to reflect the current economic conditions, which is what's driving the Fed in mortgage rates today. Mortgage industry forecasts the rates are going to go up 0.75%, but our rates already reflect that. And it's the hardest thing for people to understand, because the media so often makes the correlation. I just want to see the question that came in. Will the recording be sent out? Yeah, I'm sure that it will. Elsie, we'll make sure it goes out.
We post the recordings to our NHMR YouTube channel, and you'll find a wealth of knowledge on that channel with a lot of different meetings that we've hosted in the past.
I love it. Thanks, Rachel. I always knew God was a woman, and then Rachel always comes into these calls and I'm like, there's the voice of God. So I really want you to be able to say comfortably and confidently to your buyers. There's a slogan that's so popular now. If you're on social media, I know you've seen it. It says, marry the house and date the rate. And the reason for that is that, we know mortgage rates will be coming down, and all these customers will be in a position to refinance and glean significant savings. Now, that also creates a problem right now for us. And here's what the problem is. The problem is that markets, let's talk about Wall Street, right? And investors who are buying different things in Wall Street. If you're an investor and you're looking to go out and buy something, you're looking for probably a lengthy rate of return. Okay, unless you're like doing day trading and that kind of thing. You're looking for a lengthy mortgage. When investors invest in mortgage-backed securities, it's a 30-year instrument. Not that they ever stay for 30 years, but the way the investors really glean a return is by how long they get to hold the mortgage-backed security. So right now we're in a market where we have 7% interest rates, and yet the mortgage-backed security market is not vibrant. And the reason that mortgage-backed security bond traders are not excited about these 7% rates is because they know it's temporary, and they hate what's called runoff, meaning we know that these clients are going to refinance, and that 7% rate is going to be gone when they refinance. So what we're seeing, if you hear this, I just want you to understand why. What we're seeing in the market is there are times that we cannot offer a 0-point loan. So for those of you who don't know, a point is essentially prepaid interest that a client can pay to bring their interest rate down. It's a closing cost. 1 point is usually equal to 1% of the loan amount. So on a $400,000 loan, they're going to pay $4,000 as an extra cost to perhaps save 0.25% on their interest rate. I, as a financial counselor, am not, and it usually takes 5 years to recapture, pay yourself back from the monthly savings, the $4,000 investment, and then after 5 years, you start to realize savings. Well, what do we know is happening today? We know most of these people are going to be refinancing these loans. So I personally, if it can be avoided, am not recommending people consider paying points, because they're probably not going to have this loan for 5 years to be able to capture the benefit of it. But here's the problem. Because the bond investors are not happy with where they expect the runoff to be when refinances take place, in some cases, we're finding we can't offer a client a 0-point loan. This happens most notably with clients with lower credit scores, because remember I said lower credit scores impact interest rates. So it's a phenomenon I've never seen in my career before, where I've got a first-time buyer and we're trying to put together enough money for closing costs and whatnot, and all of a sudden they have to pay a point. There is no option for them to even get an interest rate without paying a point. So if you hear that, that's what's behind what's going on there. Questions? Thank you. LOL. Okay. So that's what's going on. Inflation's driving mortgage rates. We know the Fed's fighting inflation. Mortgage rates will be coming down. Marry the house, date the rate. Now, we could have a vibrant conversation about whether or not you guys think property values in Connecticut are going to come down. I personally don't. Okay. Now, we're not going to see double-digit appreciation like we've seen the last couple of years, but I actually believe, and if you look at the data and a lot of the statistics, it supports what I'm saying. And God, I hope I'm right. I actually believe that we'll see probably appreciation in Connecticut, maybe between 3 and 5%. And the reason why I feel like Connecticut is especially protected is this reason. We were literally the 50th state in the country to come out of the housing crisis. You guys, you know, if you've been realtors for more than several years, you know there was all these issues with, we weren't having any home price appreciation in Connecticut. Everybody was leaving the state with their pensions. We had unfunded pensions, all the reasons why Connecticut was suffering, okay? And why Connecticut was not seeing appreciation. Every year, there was a Freddie Mac chart that would get released, and it would show all the different places in the country that had been experiencing appreciation in 2014, 2015, 2016, 2017, 2018. And Connecticut was always dead last, and usually for a couple of years, the only one still in the negative. And then, thankfully, towards the end of 2018, we started seeing property values starting to lift. In comes the pandemic, In comes the housing crisis. So do I think there's a chance property values may fall in Southern Florida or in Arizona? Yes, I think there's some chance there might be some small correction there, but I personally don't think it's going to happen in Connecticut. So when we're talking to clients about whether they should buy now or wait for the rates to go up, it's usually pretty compelling if we show them what a house is going to be worth next year, if it only goes up 3 to 5% versus what it's worth this year. And then we talk about the fact that they'll be able to refinance and drop their rates. So usually that conversation brings a lot of reassurance to people that it's still a good time to buy. And let's be honest, if you follow any of the economic forecasts, National Association of Realtors, all of them, they're basically saying this inventory crisis is not going to end soon based on two things, right? There's two things that are driving the inventory crisis. One is, since the subprime crisis, we haven't been building enough houses in America to keep up with the population growth and the formation of new households. And two, the next 3 years, we have the largest percentage of millennials hitting their peak home buying age. So those two things, we believe that the inventory shortage is going to continue, hopefully not as extreme as it is right now, but we do believe that that's going to happen. And that means, guys, if there's a shortage, that means we're not going to see depreciating home values. So Yolanda and I talked in the minute up front, right before we started this, about the whether or not I think the media propagates bad news. And the answer is yes. The media definitely trades in fear, right? All the media cares about, and most television news, all they care about, and I'm the mother of a political newspaper reporter, by the way, so I have a strong opinion about this, but all television and social network, social media news organizations, all they want are eyeballs, right? They're paying to get your eyes on their stuff. And what, unfortunately, with human behavior, what gets our eyeballs on their ads is fear. So this is an example of, I think it was CNN, a CNN economic reporter who in 2015 claimed that the housing, there's a bubble bigger now. This was 2015 than in 2006. And then on the right, it shows that nationally, properties went up 5.1% that year. And now a $300,000 house is $315,000. In August of that year, she said, we're now in a housing bubble. Prices went up 5.4%. November of 2017, home ownership doesn't build wealth per a study, 6.1%. It's better to rent than to buy in today's housing market. Home price appreciation that year, 4.1. You see how this is going, okay? You see how this is going. So if anybody listened to this CNN economic reporter, and I'm so sorry I forgot her name, the $300,000 house she discouraged you from buying in 2015 is now worth $525,000. Pretty dramatic, really dramatic. And even if you don't even take, let's throw out 2019 and 2021 through 2021, just 300,000. This is normal rates of appreciation, 5.1 to 4%, high of 6.1, $82,000 difference in home prices. So even if you throw out the 2 big years of the pandemic, we're still looking at an $82,000 net home price appreciation. It's kind of hard to argue that the media doesn't sell fear, and it's really hard to argue that owning a home doesn't create wealth. People who own real estate, Americans who own real estate, have a net worth that is 9 times higher than people who don't. I believe that's it. I'm going to double check that statistic because I always want to make sure I'm right. Now, I made a joke. I was teaching agents on Wednesday at the association, and I made a joke. And it is a joke, but I want you to kind of listen to what I have to say here. This is the final thing I'm going to talk about today. Real estate is geographic. I always say it starts in California and comes east, right? And this is a trend that we're starting to see through major parts of the United States that I don't think have hit Connecticut quite yet, but I want you guys to be prepared because I think it's coming. I meant to call one of my friends and ask them, what are the percentages in MLS right now of listings that are being reduced? Like, that's an interesting statistic. Does anybody know that? Like, and are we seeing a greater number of houses where sellers are dropping their list price? This is happening throughout the country, and some of it's being driven by unrealistic expectations by sellers on whether prices are still going up so much. He mentioned renting. How do you think renters will be affected if the inventory is low? Renters, yes. Yes, absolutely, Adela. Rent is even more inflationary right now than home prices. So I've got a chart. If you reach out to me, Adela, after the meeting, send me an email reminder. I'll send you a chart, or I'll send it to everybody that shows what's going on with the rental market, and it'll give you some information about that. So what I want to talk about, remember we talked about those seller concessions that the seller can contribute towards the buyer's expense, right? So if you're starting to see where maybe the market's going to start to soften a little bit, or we start to see sellers being in a position where, they price the house somewhere and they're not getting any bites. There's a strategy that we used many years ago that has become popular again through the rest of the country. And I just want you guys to kind of hear it first. And that is what's called using a buy down, an interest rate buy down. So this is how it works. So let's say a seller listed his house for $350,000 and it's not moving, or he didn't get the attention, or you think he should drop the price $10,000. Whatever the reason is, they're considering a price reduction of $10,000. Saving the $10,000 reduction will save a buyer $600 to $800 in a monthly payment. Okay. There's a loan program that we can use called a 2-1 buy down. And what this means is that we basically have the seller pay the interest differential up front at closing. And in the scenario I'm going to give you, it's going to be $7,484. And these are the rates that the buyer then gets. So the first year, let's assume rates today are 7.25%. And we were going to do this today. In the first year, they pay 5.25%. In the second year, they pay 6.25%. And in years 3 through 30, they pay 7.25%. So you see what the monthly savings is. And again, by third year, they're likely going to refinance by now. So the thought behind this is this, right? It's less expensive for the seller to advertise and pay for an interest rate buy down for their client, for their potential buyers, than it is for them to take a price reduction. And it's going to definitely get the attention of buyers who are a little freaked out by interest rates right now. So I was on a national call where offices of prime lending, again, in the West and the middle part of the country, are starting to use this a lot right now. And one of the agents that was on the call said, yeah, but one of the benefits is you need to show the reduced listing to bring it back up in a search, because I guess it's high in the search engines when you see a listing price reduced. And another agent said she's been using it and like literally dropping it $1 or $10 or whatever the number is to basically get it to come up as a reduced listing in the searches. And the recommendation would be that in the listing you advertise that the seller is willing to temporarily buy down the buyer's interest rate. So I think if you have a listing and you're thinking about a price reduction and you want me to run numbers for you on it specifically to that listing, let me know, reach out to me. We'll make sure we get you those numbers so that you can be conversive on it. But I do think that this is a strategy that's we're going to probably see a little bit more of as the market starts to open up a little bit. And then finally, oh my gosh, I just had a thought and it literally went out of my head. Oh, it'll come back to me. Anyway, I highly recommend that you understand this and you think about incorporating it when you're going to have somebody who needs to reduce their listing. Oh, is this a one-time payment for the seller? Yes. So the seller would pay the $7,484 at the closing table. You would structure the contract. Oh, I just remembered what it is. You would structure the contract to say seller's seller is willing to pay $7,484, whatever the real number is, towards the buyer's closing costs. And then we set up the deal this way. Most important thing with this strategy is that the house has to appraise out, right? Because you're keeping the price at $350, even though they were going to reduce it to $340. So we're going to rely on you to be able to confirm, yep, we're going to be able to get this appraised value. It's not going to be a problem. Because if the house under appraises, the strategy kind of collapses. Does that make sense? Does anybody have any questions that I can answer for you? Anything I didn't cover that you would like to know more about? Was this helpful, informative? Is anybody awake still?
Great job, Kelly.
Thanks, yo. Any questions at all? All right. Thank you, Shannon. Thanks, Matt. Thank you so much, Brianne. I'm going to make sure we get you out this presentation. If there's anything more that you want to know about, or you thought you'd like to, please don't hesitate to call me. Obviously, we'd love to do business with you. It's why we spend the time helping you understand. And thank you. Thank you. She just posted the link for the site. Oh, thank you, everybody. That's so nice of you. Again, don't hesitate to reach out to us. We're here if you need us. And I hope everybody has a wonderful weekend. It's supposed to be beautiful, beautiful fall weekend out there for us. Great. Thank you. Thanks, everybody.